Hello, and welcome to the March 2023 Economic and Market Update, presented by Commonwealth Financial Network. My name is Brad McMillan, and I'm Commonwealth's Chief Investment Officer. After a strong January, markets softened last month, reversing early gains to close down slightly. U.S. markets were down by low single digits, while bond markets were in the same range. International markets also dropped, with developed markets down about the same as the U.S., but with emerging markets doing worst of all. After a strong January, it was a reality check on what we can expect for the rest of the year. What drove the declines was unexpectedly bad data on inflation, with the Fed committing to a hawkish stance and longer-term interest rates starting to rise again. The benchmark yield on the 10-year U.S. Treasury note rose by more than a half a point to above 3.9%. And with inflation projected to stay high, markets are betting on the Federal Reserve continuing or even accelerating its rate increases. Expected higher rates typically mean lower bond and stock prices, and that's just what we saw. The good news is that the inflation worries were driven by better economic data. Job growth came in at almost double expectations at over 500,000 for the month, while service sector business confidence bounced back into expansion. Retail sales and consumer spending showed strong growth, and business investment ticked up as well. So while interest rates were up, the good news is that with the strong data, a recession looks even less likely in the short term. With the job market very strong and business confidence and investment up again, the economy looks likely to keep growing. Overall, the economic risks are still contained, which is good news. It's not just about the economy, though, of course, as there are also political risks in play. Here in the U.S., the debt ceiling confrontation is moving closer. Internationally, China remains a wild card, both for economic reasons and also as it takes a more active role in the ongoing Ukraine war. And of course, there are also the risks we don't even see yet. But despite those risks, as we look ahead, signs are that things will be better 6 months from now than they are today. While inflation is still a factor, we have an economy that's stronger than expected. Interest rates are ticking back up again, but that's offset by the better economic conditions. And this mix of good and bad news explains the markets last month. And it also sets the stage for how things will improve over the next several months. The debt ceiling confrontation will be resolved, for example. We'll know where we are with the recession. And inflation and rates should roll over once more. When things are likely to get better, the downside risks tend to be contained, which is where we are right now. In other words, we do face real risks, but we're increasingly moving past many of them. We're certainly not done with turbulence, and we'll likely see more of it. But despite everything, we're still in a pretty good place. That's it for this update. Thanks for watching. Join me in April for the next one, but until then, be sure to check my blog, The Independent Market Observer, for more timely comments. Stay safe, stay sane, and stay healthy. We are getting through this together.